Hey, good morning, everyone, and welcome to this morning's event. For anybody who's joining us for the first time, you're very welcome. And for anybody who's one of our regular attendees, welcome to this Appendix 4C results wrap. My name is Mark Tobin. I'm the founder of Coffee Microcaps. I've just got a couple of intro slides I'm going to run through quickly here, and then we're going to get straight into it with our first presenter. Start off new year. We've got a new sponsor for our online events. I would like to welcome RAS Research as a Service on board. If you're looking for research on a couple of microcap companies, please do check out their website. They've got a pretty broad coverage universe, and yeah, I read them myself. And if you're looking for some decent coverage of microcap companies, it's a good place to start looking. Quick compliance and disclaimer slide. For anyone who's joining us for the first time, the companies we normally have presenting on here and the four we've got this morning are kind of no different. Capped under 300 million, that's our definition of a microcap. In revenue are approaching cash flow break even, or indeed already profitable. Generally, we don't have companies from the resources or biotech sectors, what I like to call industrial microcaps, which covers everything from tech, healthcare, consumer goods, professional services, business, retail, FMCG, all those kind of other geek sectors, if you want to call them that. Structure, we got 4 companies presenting. Each company is going to get 20 minutes for preso and 10 minutes of Q&A. If you do have any questions, please type them in the chat function at the bottom. We will then get to them at the end. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday. You can follow us pretty much on all the socials. Twitter is our main one, YouTube for the recording of this webinar, and indeed all our previous ones. We've got well over 100 events on there now, probably close to 200 microcap companies. LinkedIn, and I also write a free monthly newsletter. Our first presenter this morning, I'm delighted to welcome back Subhash Challa from SenSen Networks. You might already see him on screen, first time presenter, but shouldn't be a stranger to small and microcap ASX investors. Mark Simari from Careteq. Then we're going to go to Brisbane. We've got Geoff Jamieson joining us from Orcoda, also a first-time presenter. And then I'm delighted to be welcoming back Brendan Malone from Raiz Invest. But that's enough from me. So I'm going to stop sharing. And Subhash, if I could ask you to please start sharing your screen, and I'll let you know when I can see it coming up on. Yep, that looks good. Subhash, you can take it away whenever you're ready.
Okay, good morning, everyone, and thanks for taking the time to review our company and see the results. We are obviously ASX listed, and today we are very proud to reach an important milestone of reaching cash flow positivity. So very excited to present our company. So who are we? So we are world leaders in delivering live awareness solutions to cities, citizens, and corporations using a subfield of AI called sensor AI. The key update we want to share is that we have hit the cash flow positive milestone for the first time since listing. It's obviously a constantly evolving scenarios, and we are on track to keep it that way. However, in achieving that cash flow positivity, we have to take significant steps in managing our costs, reducing headcount, IT expenses, legal expenses, and many other things, and all driven by maturity of our products and solutions, rather than just chopping it for the heck of it. So that correction and timing of some of our COGS expenses due to big contracts that we have won recently, which I'll cover later in the show, our Q3 could be slightly negative, but then we'll be back on a long-term cash flow positive trajectory and profitability. We have optimized our management structures to reflect a company going from 1 million to 10 million is what we have done up to FY23, and now we are heading from 10 million plus revenue to much higher numbers. So to reflect the scale and optimization we had to achieve, we have restructured our company to reflect that. There's a board review underway to bring independent third-party chairman and independent directors, and also look at how the board performs to support this kind of growth that we are entering into. The cost reductions we achieved are in excess of $2 million on an annual basis due to the changes that we have implemented in the recent times. Of course, we are using the cash flow positivity and the balance sheet to reduce our debt, and we'll continue to do so in the times to come. This is a very important slide to give you a bit of an idea of how our quarterly cash flow receipts are coming in from the customer. So if you look at the graph here that tells a story, the different colors are for different financial years and the different quarters are here. So this is Q1 2021, Q1 22, and so on. So if you see in every quarter, we are constantly being increasing the revenues. So in the last 4 years, they have been growing, and even this year in Q1, we achieved about 17-18% growth. In Q2 as well, we are achieving we achieved this similar type of growth and crossed 3 million again. And we expect continuous record-breaking performance into the future. This is our revenue split by region and our global footprint. If you look at it, our revenue generating solutions belong to these 4 categories: enforcement solutions, surveillance and loss prevention solutions, curbside management solutions, cloud AI and data analytics solutions. So these in combination become solutions to smart cities or retail or different verticals that we operate in. We are predominantly smart cities player, but we do have strategic revenue streams from high value markets that we have entered in either through acquisition or organically. If you look at our revenue growth profile, you can see that the growth rate is consistent, and yet it is particularly important to understand, or at least review, that we have been growing in spite of COVID, in spite of inflations, in spite of so many other headwinds that have been coming and hitting the company. We have pretty much survived all that, and now we're taking off. A quick one slider on what is our technology IP or secret sauce. We have been building a software platform, SenSen, which is a live awareness AI platform. And what it does is it takes data from any kind of input source like cameras, sensors of different kind, and then fuses the data, analyzes the data, and creates outputs that can be consumed by enterprise platforms. So we have an enterprise integration API that comes on the edge of the SenSen platform, and the input is any kind of sensors. This architecture, we have shown that it can solve a broad range of government and enterprise and business problems. So it has always been a platform play, and we had to pick a set of markets where we become king of the hill before it goes into blue sky other applications. So that market is our smart cities market. So we call it roads and parking here, where we have solutions in road safety, traffic analytics, civic compliance, parking management. This reflects like 60-70% of our revenue. And we are, of course, in buildings and spaces like airports, seaports, retail stores, which are very strategic, market segments, and we're growing in there. So in the last quarter and leading up to the Christmas, one of the big achievements has been to win a major national federal agency contract called National Heavy Vehicle Regulator. Their job is to monitor roads for heavy vehicle use and safety that revolves around them. And it's a high-profile project. We won a POC type project a few years ago, and now this tender was about truly rolling out into production and scale. So systems like this, which are trailer-mounted, solar-powered, rapidly deployable systems or vehicle-mounted systems, we even have drones that were given to them before. In different modalities, National Heavy Vehicle Regulator wants to use the systems to efficiently track heavy vehicle activity on roads. We started off small with 2 systems in use of different kind, and now we are extending to 27, and the potential additional units of 19 that can come. So currently the order value is 4 million, upfront revenue is 1.5, and there's annual recurrent revenue, and then add-ons that come with it. But there is a standing offer arrangement. Should NHVI require more, they can order more under the agreement. Of course, we have some groundbreaking, patented and really revolutionary projects in curb management, and the new orders that came in for these additional solutions like curb messaging, curb enforcement, curb mapping, curb monitoring. These are all AI-driven, sensor-driven technologies, all configurations of our Sendisa platform. We have received over $1 million in additional contracts on top of the NHVR project that we got. Sorry. We also have a very targeted business that we acquired called ScanCam, and it's Australia's largest network of fuel retailers sharing data to reduce theft. Okay. Our numbers are staggering. We have 75,000 national offender databases. Pretty much all major retail fuel retail brands are with SenSen, and we have prevented theft in excess of $20 million. And the network is growing. So when we acquired the business, a couple of years ago, it was 200, 250 stores. Now we are between 400 and 450. So, and the rate at which it's growing is impressive. Now I want to focus a little bit on our North American strategy, which has been predominantly my focus the last year. We have targeted the Smart Grants program, where all the solutions that we have been developing and become a market leader in Australia are relevant under this program. It's a $100 million program. Multiple cities have already won these grants, and they are looking at introducing innovative solutions. 49 projects were approved, 9 of them are for curb management, and each one got $2 million each. So there was a $20 million innovation grants that are there, which SenSen technology is very relevant. We have established several channel partnerships that are targeting this and needing solutions from SenSen. So in that context, we had a successful partnership established Blue Systems. It's a part of a multi-billion-dollar French group, but has significant presence in SenSen in US. And together, we won a contract with a government procurement agency called Sourcewell, which allows individual agencies or government councils and government departments who wants to acquire technology like SenSen can bypass the tender process, because Sourcewell is a government-approved tender procurement panel kind of agency. Winning that along with Blue Systems has truly set us up for accelerating our revenue in the US. We're currently doing trials with San Jose and LA DOT and many other things. And as soon as customers feel confident and want to procure something, there's no barrier and delay between that. So this is a very important strategy, a good achievement for SenSen to accelerate revenue in the US. We also established a very strong partnership with GTECNA, which is a smart cities player providing enforcement solutions. And just in the last year, we added 10 plus cities through them as a channel partner. So I think one of the important pivots that we had to do was to use our direct wins that we got, which we had to do as a groundwork because channels don't represent you until you have proven products in a region. However, having done that, we had to get strong partnerships established who can accelerate revenue, which is what we have done. I intend to go back to US again soon to further establish other strategic partners and work with the existing partners to accelerate revenue. This is very important to see how the trends of the company are going. In FY23, the company pivoted to serving focus markets with standardized products. This also helped us cut costs and make it very focused in terms of how we drive to profitability and cash flow positivity. So those changes led to revenues going up, gross margins going up, losses going down, and cash flow going down, cash outflow going down. So if you look at it for the first time, we crossed the magic number of 10 million. And this is actually powered by strong ARR, long-term contracts with government customers. Our churn is still minimal. Our net retention rate is a bit over 100%. So all the metrics are in the right direction, and crossing this milestone is significant for SenSen. But the more interesting point is that we are cutting revenue, we are cutting our costs significantly, pushing the company to positivity, cash flow positivity. So if you look at our half-year results, for the first time, we have grown our revenue 17% and achieved cash flow positivity. We expect the revenue growth to continue the momentum into the rest of FY24 and beyond with sustainable cash flow positive operations into Q4. I also want to highlight and remind shareholders and people who are looking at our company for the first time, there is a hidden Trojan horse, if you want, or a strength that SenSen has, is that there is a very high lifetime value of our customers. When we acquire our customers, we kind of get in at a modest revenue, usually through POCs or some technology trials. But then the customers keep increasing the revenue. And what started as a few $100,000 or sub-$1 million projects end up into multi-million-dollar projects for customers. We just took 6 customers from our existing list to show how that growth profile happens. So there are very deliberate strategies on how we have introduced products, and he created barriers of entry for our competition to have the sustainable growth and consistent long lifetime value of customers. 99% of our customers that joined us before listing still did not leave SenSen. They're still our customers and they're still spending more. So the last 5 years, revenue from key customers increased over 3.5 times or 350%. And this is a deliberate strategy, and we have been implementing that to survive all those headwinds that we have got. And now I think the replication formulas have been set, so we hope to scale faster from here on. That comes to the end of our presentation, and happy to take any questions.
Cheers. Thanks, Subhash. I might just kick off with the first one. As you mentioned, I think the last time you were on here, you were just imminently, moving across to the US to kind of drive the business and the customers. And just impressions now that you've been on the ground there for, a good few months. Is it, a bigger opportunity set, or kind of what you expected? Just give us a sense of having been on the ground yourself now for a couple of months. What what the opportunity is maybe now that you kind of got a deeper sense of the market and, the Sourcewell going through that process with those guys and what needs to be done to actually get real business moving in the US.
Yeah, I spent 5 months last year, not a couple of months. Okay,
Okay,
in
5.
two different fields. So I spent substantial time to get a very good understanding of the market forces, the dynamics, and also the changes we need to do to our product. Because what works in Australia doesn't just straight away you can plug into US. So we had to modify pieces, which we have been able to feed back to our CTO, Dr. Duke Wo, and they have modified the products a little bit to better fit that. That's one part of the exercise we had to do to get a better product market fit in that region. The second thing is about understanding the ecosystem and the players who are all targeting big bucket loads of money that is in the US. US is probably 20 times bigger than Australia. And if you have an invention that is global and in nature, as we have proven in Singapore and many other places, the best market to focus on is North America. And we have done all the hard yards, even through listing or before listing. The company was always born as an international company with an international ambition. But we had to do the hard yards of getting big accounts like Las Vegas or Chicago and Calgary and Vancouver and Toronto. These are the direct accounts that we had to win through our own strong technology and credibility. And now the channels are coming to us to say, oh, this is really good. And they can see how they can make money by working with SenSen. So it was an important time that I've spent, and I think I need to spend a bit more time to consolidate that play, and few more partnerships have to be established. But I think with the work that we have already done, the funnel is there, and we should start seeing US becoming first almost as big as Australia in the next 12, 18 months in terms of revenue, and then growing bigger beyond that. That's my hope and expectation, which we are working towards.
Okay. I mean, maybe just on that, yeah, you had the revenue split pie chart in the thing. I was going to say, out of those 3 sections, is it fair to say the US is the most exciting opportunity, or I mean that the National Heavy Vehicle Regulator contract, is nothing to be sneezed at, either, where SenSen is today. So, it still seems like there's quite a good opportunity within the Australian market as well. Are they kind of equally the same in terms of opportunities? If we, let's say in the next 12 months, if we just look forward, that there's still plenty of business to be won in Australia.
Yeah, we have very strong leadership in Australia, driving sales and revenue through Nathan Rogers, and he's a strong player. He knows the smart cities market, and we have a strategy of how to multiply revenue here, and it doesn't need my focus or attention because it's pretty much self running. And we should expect greater things from Australia, because we even in Australia, although technological leadership is there and we have created critical mass of customers who are adopting our solutions, it's still probably we only took 10% of the market. So we have a huge growth to happen in Australia. So I would expect the team locally hitting those things. And with my focus in US, I'm doing what I've done with Australia to establish the foundations and hand it over to someone like Nathan. We should be doing the same in the US. So, which is exactly the process I'm in right now, where we have done the groundwork and we're trying to get some key leadership hired into that place. Not immediately, but as opportunity arises, then we can scale a lot larger. So I would say in the short term, both will be kicking good goals. Of course, US will be trailing Australia because of the longevity we have in Australia and a more mature sales and delivery team here. In the US, it's more about doing that entrepreneurial early stage work that will set the foundations for the future.
Okay. And just going back to the product you have on the fuel theft side, you said that's gone from 2 to kind of 400 since you guys acquired the business. What's the kind of total opportunity for that business? I mean, there's definitely more than 400 fuel stations in Australia, but maybe just give us a sense of what you're targeting there. Is there a competitor to you guys, and what are the kind of market dynamics there to get that business on maybe from 400 to 600?
Yeah. Now, the total opportunity there, if you just look at fuel retail, is more than 6,500 fuel stations across Australia. So we are obviously the dominant player, a bit over 5%, between 5 and 10% right now, and growing. And we can easily scale to 10 without much effort. That's already happening. But once you cross 20, 30%, the dynamics of fuel theft is going to change. There are competitors who are overseas based, like in New Zealand or UK or somewhere else, and they're trying to come in once in a while. They take small places. But the beauty of this solution is that your ability to stop theft is directly proportional or almost infinitely, like a exponentially proportional to the number of stores you have in the network, because every store is reporting theft, which is used to stop theft in every other store. So it's like a network effect is exponential. So so we're already the leader. So it's hard for new people to come and say, I'll put my technology in one store or one group. They don't get the benefit of 400, 500 stores where theft is happening, which is what SenSen is doing. So that's why we had to acquire a business which is about critical mass and accelerate our own things in there. We are facing some challenges in dealing with the scale, like, what used to be a small business with a few hundred stores in one location in Perth has become a national network. And we had to change some operational dynamics and support dynamics in that. But we are on our way. I think we have nailed all the foundations. We have restructured it a bit to scale from 200 to 400 now, and 450, I think. And we're setting it up to go to 600, 650 in the near term. Yeah.
Okay. Just a question on the operations. We got one in from the audience about, I think maybe it's a broader question we can talk on the restructure last year. The question is, staff have exited the business, but given what you've outlined on the growth side, is it a case of you might have to be hiring back some of these positions, 6 months down the line kind of thing? So maybe just talking kind of broad terms about, staff that exited the business and, any staff you might need to hire if, the kind of growth comes through the pipeline as expected or not.
I think we are pretty much stabilized with long-term staff in the company, meaning like, if we need people, we'll be getting in contractors, short-term things to manage the hiring in proportion to the revenues that are coming in. We don't need to hire any more in the core technology or product building or things like that, or customization. What we have is already enough to support those future changes for quite some time. So people who will be coming in will be project managers or customer support or a few things that are localized, but they all can be done through contractors. And we'll be introducing something called SenSen certified support staff, or SenSen certified engineers, just like some big companies will have. People who know what we're doing. And because attractive and in the AI space, that kind of process will increase people subscribing to a knowledge base of how to support SenSen. So that allows short-term contractors or people coming on job and finishing and going on. So those kind of structures is what we'll pursue if we ever need to grow, and if revenue goes really fast and we need a bit more people to support that kind of deployments, it can be done through those contractor arrangements.
Okay. And then maybe just one quick one I want to touch on. Maybe it's a bit early to be thinking about, but if you say the US is going to kind of balance Australia, it does kind of bring in a bit of exchange rate risk and benefits, kind of one way or the other. How are you thinking about that in terms of, getting US based costs to kind of, naturally hedge some of the US revenue that's coming in, or has that kind of been
as today, the US revenue, US and North America, if you try to take Canada and US together, it's profitable business already. It's actually feeding positive cash into Australia for the current revenue stream we are having. We're not likely to change that. So we'll be growing revenue, but we have a global workforce. distributed time zones. We don't need people in every city or anything. It's more strategic locations we have. So I do expect that more revenue to come from US without increasing, not necessarily increasing any costs in that region. I mean, there may be modest cost increases just to correct the leadership and a few other things, but not anything that will hit our total bottom line of the story.
Yeah, no, just something to keep in mind, the kind of exchange rate benefits and our costs that can kind of swing with the results in future, to maybe look a little bit deeper of what the FX impact is going forward.
I mean, for a founder CEO that I have been, this is probably the most exciting part of the business. I mean, for all the years I've been always chasing trailing expenses, but not losing the vision of growing the company. And now we flipped around where we could have products that are generating constant cash and they have their own demand that we have created. But now we are really worried about how do I take my 10.8 million of 23 to 20 million and 40 million and the bigger dollars that we need to come. So the way it need to operate has to be different. So I think the leadership team that we have now stabilized after all the cost cut and people removing, going out from the business naturally or otherwise, is now freeing me up to focus on those strategic stuff that I have to do. Yeah.
Okay, perfect. Subhash, thanks very much for joining us, and safe travels back to the US whenever you're going back, and hopefully we'll get you on maybe in the second half of 24.
Yeah. Thank you. Thanks for your time and the viewers' time, and wish you good luck for Mark and other presenters as well. Okay. Thank you.
Cheers. Thank you. And yeah, we'll hand over to Mark Simari now from Careteq. Mark shouldn't be a stranger to a lot of people on here. He's been involved in many a small cap, micro cap healthcare company down through the years, but first time here on Coffee Microcaps, and we're delighted to have him. So Mark, please take it away.
Thank you very much, Mark, for having me, and hello to all the viewers on the screen, and hopefully potential investors. Careteq, yes, is a company that got listed about 2 years ago. Was private before that, and so it's been quite a journey to get it to where it is today. We're a combination. So we're a combination of a health tech company with medication management adherence, and we're tapping into that whole aged care seniors market accordingly. From a board point of view, myself as executive chair and the three gentlemen listed there below. 3 of the 4 of us come from another listed company called Paragon Care, which was a very successful healthcare company that set up a lot of networks and foundations for our roadmap for Careteq success. For those who are not aware, Paragon is a sort of 250 million market cap company and one of the largest independent suppliers of capital equipment and consumables and so forth into the healthcare sector. So that enabled us to get a lot of network capability through this initiative. So as a company, we specialize in a number of areas. We have our proprietary platform. I'll go into more detail on these three pockets in a moment, but just as a summary, our business model is to build a platform of recurring revenue with a diversity of revenue streams. So we have on the far left, we have Sophie Hub, which is our proprietary platform, and it has 2 revenue streams, also 3 revenue streams. We do have hardware devices that go through the platform to provide solutions to the market. And then we have recurring revenue streams, both from a platform SaaS revenue and also SIM revenue. A number of our devices have SIMs in those devices. In the middle is our most recent acquisition, HMR Referrals. It's a home medication review marketplace. So we basically partner GPs with pharmacists across Australia. That GPs make referrals into the platform, and pharmacists complete those referrals and conduct a medication review for seniors in Australia. I'll elaborate a bit more on that. And then to the far right, we have Embedded Health Solutions, which is our JV vehicle. We own, Careteq owns 55% of it. It's the more mature part of our business model. It's quite profitable and growing at a nice rate. As far as the market size, the market we're targeting is very large. both from within Australia and globally. Our key focus is definitely Australia. I'm a big fan of if you get your backyard right first, and then venture out to beyond that. We feel we're making some really good penetration in Australia. We have a very large pipeline of opportunities coming through, and we are present in the US, but not we don't employ too many people over there and whatnot. But we do have some channel partners that we're working with there to try and create some revenue growth as well. But it's still early stages for that. So the Sophie Hub platform, as you can see on the screen, so in the middle, you've got the Sophie Hub cloud platform. That's our proprietary platform. That's where the company originated from. It originally came out of Deakin University here in Victoria, and commercialised by Careteq. And so we use this platform to identify key areas that solves problems in the community. And so we've targeted 3 key areas, and a number of other areas are coming. So falls is a very large problem in the seniors market, both in an aged care community and home care community. So we represent another company's product, and we rebranded it as Tech Falls Alert. It's integrated into our Sophie Hub platform, and effectively it's a radar that sits in a room, covers a 4x4, 4x5 room, and if somebody was to fall below a certain threshold and not get back up, it would send an alert to emergency lists at an enterprise level, to nurse call systems and so forth, to let them know that Mr. Smith or Mr. Smith has fallen, and they need care attended to. So that's a product that's been in market for about 3 to 4 months now, and we've got a number of trials underway, a number of integrations with various platforms that help us get into market. And so we're quite excited about what the future will bring on that front. Next is our Tech Home. It's a hub type application or hardware device that goes. It's more for home care, not really an aged care product. It has PIR sensors that go around each room, and it has a SIM card inside it. And the key functionality of that product is it does medication reminders, it does activity monitoring and reporting, and two-way voice. And so, as you might appreciate, as people get older, they're taking a number of medications. The timing of those medications are really important. And so we see a lot of people using our device for medication reminders, so that they don't forget or take double in the afternoon because they forgot to take it in the morning, and so forth. Next is our Tech Secure and Tech Life. So these are 2 pendants, PERS devices, wearables that both have SIM cards. They have geofencing, geo-tracking, and so if somebody's in the home, they can wear it on a lanyard, they can wear it on a belt clip, just carry it in their pocket. And when they leave the home, you've got a geofence around that home. You'll get a notification to let you know the loved ones leave the home. And then you might have other destinations such as shopping centres and whatnot, and you can keep track of them wherever they go. It has an SOS button. If they get themselves in any trouble, they can press that, and that will go to the emergency contacts as well. And then it also has a falls detection capability in the device. So if they did have a fall out in the supermarket or streets or whatnot, then you would get an alert associated with that. So these are our current hardware devices integrated into the Sophie Hub platform, and so we go to market where we don't focus too heavily on making a huge amount of margin on the hardware devices. As I said earlier, we're more focused on the recurring revenue streams that we can create. And so we sell these into the communities and into a number of verticals, being aged care, home care, disability care, and personal safety. And so our key subscribers, sitting at we're approaching 8,000 subscribers coming up. And so our pipeline to reach our target of 15,000 is looking very promising, and so we're anticipating to get to that target by June this year, if all goes to plan. As you can see from the chart, we're seeing some nice growth. It's been ramped up over the last sort of 12 months, where we've almost doubled the subscriber base. And we see that continuing on in that trend, and hopefully, once we reach the 15,000, we'll reset our targets to head towards that sort of 40,000-50,000 as the next hurdle that we want to target for. We have a low churn, which is really nice in this sector. We have a very sticky customer base. Without being morbid, generally when we lose a client, it's a subscriber, it is unfortunately due to death, or if they're in their home care disability communities, when they enter into aged care, then generally some of our devices don't transfer to aged care, and so we will lose them as subscribers that way. But at this stage, we have a very low churn, and so our net gains, we don't have to do double the numbers to get to our targets. If we get to 15,000, the churn will be very low. HMR Referrals is a business we just recently acquired in November, December last year. And it's effectively a marketplace that enables GPs, home care providers, and pharmacists to complete medication reviews for elderly people in the community. Not sure if people are aware, but as the older you get, you tend to have a lot of medications, and what the key problem medication reviews covers off on is if you have the most prominent problem is if you have 5 or more medications. Generally, sometimes because you've gone through a journey who has prescribed those medications, the mix of those medications might conflict and have a detrimental effect on the health of an elderly person. And so accredited pharmacists that we have in our network, some 500 odd, they conduct medication reviews once a GP provides that referral for that seniors person in the home, and then identifies if there is any conflicts within those medications. And if there is, they'll put a report in, send that report, make recommendations on, maybe substitution of medications that still treat what you're trying to treat but don't conflict. Send that back to the GP, and then the GP will choose to do what they'd like to do with that recommendation, either follow the recommendation or adjust the recommendation because they might have different meds that they'd like to prescribe. This program is a government-funded program under the BBS, and so we charge a referral fee through the platform for pharmacists to collect the work from us. We're in the process, post acquiring the business, rationalising how we go to market with this. Historically, the way the platform worked was one referral in, one acceptance by a pharmacist. By talking to a number of pharmacists, what we found is if we're able to batch a number of these referrals, and the market for referrals is quite large, then we're going to get a higher take-up of pharmacists accepting work on the platform. And so we're tweaking our offering so that it could be 3 to 4 within a 5 to 10 kilometre radius that enables a pharmacist to actually fill a whole day doing a review and make some good money out of it. And so we're really excited by this new acquisition that's come in, and it cost us $500,000 to acquire, which $250,000 was in cash, $250,000 in shares. It's got $300,000 of recurring revenue, and we see it should be profitable and cash flow positive in the near future with the growth initiatives that we've got, and once it's fully integrated into our full tech offering across the Careteq group. Also, the thematic is very strong. There's legislation coming through over the next 12 to 18 months for home care providers to increase their clinical care offering within the home care packages that they manage. And so we're getting some really strong engagement on talking to some of the larger home care providers who are looking to combine what's called quality use of medications or medicines with home medication reviews to up the ante on their clinical care aspect of their offering. So that's going to help us propel growth pretty fast in this business unit. Third part of our business is embedded health solutions, and it's a JV. We own 55% of this. This is a more mature part of our business. We're turning over close to $5 million and 1.5 mil of EBITDA we expect to make on this financial year. And effectively, it's very similar to the home medication reviews business, except this is for the aged care market. So instead of HMRs, you'll hear the term of RMMR, which is residential medication management reviews. And so we have about 55,000 aged care beds in the marketplace under contract. Once again, this is a government-funded program, and so every aged care facility is required to run medication review adherence programs. and that involves medication reviews themselves as well as quality use of medications. And so we work closely with aged care facilities to provide this service. It's free to them, and they get a number of fantastic insights on how to best manage their medications through their various facilities, and also through the reviews. We do improve the health of their residents, and so without being morbid once again, but the business of an aged care is not only for provide care, but it's occupancy rates and keeping them high, because they do have to have certain levels of occupancy rates to ensure they make a profit. And so by us doing the medication reviews, it improves the quality of life of their residents, which in turn extends their life from there. So it keeps them in that facility for longer, and everybody wins. We have some 60 odd accredited pharmacists in our network that provide visiting aged care facilities every day, providing this service, and so this is a really nice fit in with the HMR referrals business that we just acquired. And so you'll see a lot of joint initiatives between the JV and our recently acquired asset, how we go to market together to tap into that home care market, in addition to the aged care market that the business currently focuses on. So operationally, as I said, we're close to 55,000 contracted aged care beds across over 5,500 facilities. We conduct over 42,000 reviews per annum. This is a government-funded initiative, so even though we're contracted by aged care facilities, we get paid by government, and so it's very safe, very regular revenue stream. A lot of our revenues are contracted in nature, so we have 2 to 3 year contracts with our clients, and we work closely with them to continue value adding to their business and expanding our product offering. From a growth point of view, there's a number of areas that we got some key focus areas. And so these are our priorities. So what has been already achieved is in the early stage of this financial year, or the back end of last financial year, moving to the early stage of this financial year, we had a strong focus on reducing our cost structures. So we've successfully removed over 1.5 million of costs from our setup, which is getting us closer and closer to profitability and cash flow positiveness. So it's good to focus now on the growth of the business and not so much on cost-cutting exercises. Our second priority, and all of these priorities are all happening simultaneously. We don't do one at a time. The second priority is we really want to get our subscriber base up to 15,000 plus. And we know once we get to 15,000 plus, and with the additional businesses that we have, that we get to a break-even cash flow positive. So it's a really important milestone that we've set ourselves, and we want to get to that by June, which moves over to priority number 3. And so to help us get to that target, that we've set ourselves a target of 1.5 million EBITDA for the embedded health solutions business. And that is, the half year, we're reporting our half year coming up, but we can confidently say we're on track, and very confident that target will be reached for FY24. As I said earlier, priority number 4 is we want to get to profitability on an operating basis across the business. And so the 15 subscribers plus the growth in HMR referrals combined with the embedded health solutions profitability, we're very confident we can get there by June this year, and head into FY25 with a positive cash flow outlook and profit growth, and accompanied with sales growth. And then priority number 5 is most recently from our acquisition. We want to really capitalize on the opportunities that the HMR referrals marketplace platform provides us. It's really exciting. There's just early stage ownership has shown us a huge amount of opportunity available to us in that space, and does provide us with some cross-selling opportunities on our Sophie Hub assisted technology side as well. And then additional growth opportunities. We do continue to look for new products. So we are evaluating vital signs monitoring radar as we speak. There's a whole range of seniors technology products that we're exploring. And then we are looking at care note technology and applications in aged care and home care to see if there's any opportunities in that space. The lone worker market is a really exciting growth area for us. When I spoke about the US market earlier, we are starting to see some traction on this front. And so we have a very large pipeline growing in that lone worker market. Conversion's taken a lot longer than I would like, and I'm not that patient, but growing to be on this front. But it's not a highly resourced initiative for us. We just work with channel partners over there, train them, provide the technology and products, and allow them to take us into market. So it's a very low cost, high potential opportunity for us. And then hospital in the home is an emerging area of healthcare. More and more, there's incentives for healthcare funds and governments that we keep people at home for longer. And so the more services you provide for that, then that keeps them out of hospitals. And so we're looking for opportunities on how we can tap into that and capitalize on those opportunities. And that's pretty much it. Happy to field any questions anyone might have.
Cheers. Well, let me get my video back on here. Cheers. Thanks, Mark. I might just kick off the first one. In terms of if we're looking forward, 12, 24 months in Careteq, should we expect more M&A to kind of build out the business, or the three verticals you got now kind of where you want to be, and it's a case of scaling those three divisions? Maybe just touch on that for a second, if you could.
Yeah, sure. It's going to be both. Anyone who knows me and my background, M&A follows a lot what I do. So we do come across a lot of opportunities to bring into the Careteq business model. And so the answer is yes, but not. We are cognizant that our market cap is relatively low, and so we're cognizant not to dilute our shareholders too much. So it has to be very strategic, has to be quite high value proposition and within our means. But we don't want any M&A programs to distract from the growth opportunities of the three business units that we have. And so that is our core focus. There's a stack of opportunity amongst those three, and there's an upsell, cross-sell opportunities within them as well, outside of just natural market growth that can be achieved. So it'll be a blend of both, but it'll be 70-80% core business, and then a flavour of M&A. And then if something really sexy comes along, then I won't be able to help myself. I'll do it.
Okay. We've got a couple of questions come flying in here now, so let's try and get through these. One on the target for profitability, just a clarification. Are you talking about at the EBITDA level or the NPAT level for FY25? EBITDA level.
So
okay.
EBITDA level. So our aim is to be EBITDA profitability heading into FY25.
Okay, that's perfect. And then one, medications assigned to patients come from the hospital discharge as opposed to their GP. How do these patients then get into the monitoring phase or the monitoring program? If that makes sense.
From a hospital in the home, is that the question refers to?
It doesn't say, it just says, if you get discharged from a hospital with, a script to say you must be on this for the next, 12, 24 days, how does that monitored?
Yeah, so if it's in relation to medication reviews, even within hospitals, there are GPs that can make the referrals for the reviews. And so we are currently, that's one of our other growth channels, is we're currently evaluating how do we target the hospitals' admissions programs. And because under the home medication reviews legislation, every single person who's released, was discharged from hospital, qualifies for a review. Now, if they have no medications, no GP is going to make that referral, but they actually qualify as a general pool, and then the GP within the hospital or the patient's GP can make a referral for a review to be undertaken. If it's on the technology front, at the moment, it's an area we're investigating, so we're not really tapped into putting technology devices into, the hospital in the home initiative is one we're investigating more so than commercializing at the moment. So that's one of our growth initiatives. But the way I would see it working is potentially it's a combination of healthcare funds and hospitals, because they're always at loggerheads. You discharge someone too early, and then there's penalties for hospitals if someone readmits back into a hospital because they were discharged too early. So there's metrics around these, benchmarks around that. And so we would see the technology for working in that manner where the hospital would be engaging with us and companies like us to provide services that would help them ensure that anyone they're discharging does not come back too early, and hopefully it doesn't come back at all. And so that's how that would work on the technology front.
Okay, and then a question on the 1,500 ADT New Zealand units. Do they need to be sell? Was it they need to sell it through first to each end customer, to be signed up and onboarded, or is there the bank of like 1,500 already sitting there, and it's just a case of getting them onboarded? I think it's more a question of, is it they've committed to 1,500 but they need to sign up, or they've got 1,500 that need to be onboarded, I think is the question.
Yeah, no, they've got, so when they place purchase orders with us, there's only a small element that is for stock. The rest of it is they have the destinations already earmarked. A number of these are 3G to 4G/5G conversions, and a number of these are also packages that they manage in New Zealand. And so the timing it takes to onboard the people is more to do with their scheduling. And as you can appreciate, they can't onboard 1,500 people all at once. So there's a program but they're not buying 1,500 for stock. They're buying 1,500 because they've got destinations for them. And so we're hopeful this quarter the whole 1,500 will be onboarded, and we can start talking about future onboarding.
Okay, great. And then another question around the break even. I mentioned the 40,000 subscriptions. Does that line up with EBITDA break even, or are the two of them two different metrics?
Yeah, two different metrics. Sorry if I confused anyone on that. So the 15,000 subscribers combined with our profitability with EHS coming on board and the embedded health solutions profitability, it's that combination, and that will turn us to cash flow positive and profitability. And when I say profitability, I'm more referring to the recurring revenue in our Sophie Hub 15,000 subscriber base. There will be months where we might be positive because of the nature of hardware sales in that month. But for me, that's not a sustainable, profitable model. I want to see recurring revenue covering our headcounts and expense base and so forth, and the profitability through the other services that we provide. And so the 40,000 number I targeted, that's when we get to 15,000, the job's not done. That's just stage one. And we've still got a journey ahead of us. And so it's just a number. It's not a board approved number or anything like that. It's just a number I flippantly said in the preso. That when we reset the next target is not going to be a mediocre. Let's get to 20,000 now. It has to be a material lift. And so when we get to 40,000 subscribers, we'll be extremely profitable at that level.
Okay, great. And then just one question finally for me, if I've got time, I have to squeeze it in. You've got the JV now in the third business. I'm not 100% sure of the exact name of it, but you're at 55%. Do you guys have an option to exercise and go to 100% in that business, or what is the kind of agreement on that JV?
We do have an option.
Okay.
Yes, we do have an option through the shareholders agreement in that. And we also have to seek approval. So if the other shareholders wish to sell their shareholding, notwithstanding our first rights, we have to approve who the other party is as well.
Okay, so there is an option to make that a fully consolidated 100% on division.
Yeah, at this stage we're not looking at doing that, but that's an option always on the table.
Okay, and then in terms of we're into the budget season, if I can say that, and a lot of your money does come from the government. In terms of how they actually pay you, is it on a monthly basis, quarterly basis? Just if we're looking at cash flows, is there seasonality in it, in that the government bunches them all at the end of the year, the start of the year, or is it quite a consistent? If I look at 1, 2, 3, 4 kind of 4Cs, there's not going to be big swings due to government payments flipping from one period to another period.
No, we're quite fortunate that it's not a government program where it's lumpy. So effectively, on the medication review side, in the embedded health solutions JV, we get paid monthly on the reviews. So we get paid on a per review basis. So if we do 2,000 reviews that month, then we'll get reimbursed for 2,000 reviews. And then we have the quality use of medications revenue, which is also from government. That is paid quarterly in arrears. So you complete your quarter, and that's measured by how many bed licenses you have under contract, and then that's quarterly. So no, that's a serious chunk of money, but it's pretty evenly every quarter you get that money. So there's no one half bigger than the second half, or 1 month bigger than the other 11 or anything like that. It's very balanced.
Okay. Mark, we're just up on time, so I think we'll leave it there. We haven't got time to squeeze in another question here. Thanks very much for joining us for the first time here on Coffee Microcaps. It was great to hear the Careteq story firsthand. And hopefully we can get you back in maybe the back half of 24 sometime.
Thank you very much, Mark. And good luck, Geoff, in your presentation. It's been great. Thank you.
Okay, we'll head up to the Sunshine State here now, and I'm delighted to also a first-time presenter at Coffee Microcaps, Geoff Jamieson. Take it away.
Good morning, Mark, and good morning, everybody. My name's Geoff Jamieson. I'm the Managing Director of Orcoda. I'll just get up at the... just hang on, I'll just have to get this up. Share the screen for a second. Just let me know when you can see it.
Yep, I will, Geoff. No worries.
Can you see that?
Not. Oh, sorry, it's coming through now. Just give it a second. Yeah, and if you can just make it full screen, it's a little bit small at the minute.
Let's go to slideshow for a second.
Yeah, and then slideshow. And I think we should be good, Geoff. I'll tell you. Yeah, that looks perfect. Yeah, that looks perfect on my side, Geoff.
Fantastic. All right. Thank you, everybody. Sorry about that. So Orcoda is a smart transport technology solutions provider. Our ASX code is ODA. Orcoda stands for, or came from, the wording organise connected data. So that's what we do. We organise connected data across multiple platforms. Just a quick disclaimer that I have to put in there. I won't go through that, but it's there if anybody wants to read through it. In this presentation has been obviously authorised by our board of directors. Orcoda is a leading provider of integrated smart technology solutions in transport logistics, workforce logistics and transport infrastructure. We're dedicated to optimising our clients' operations, enhancing efficiencies, connectivity and compliance. Our mission is to be our clients' trusted partner in their digital transformation journey. Our clients include some of Australia's largest companies in the transport logistics, healthcare, logistics and infrastructure and resource sectors. And our long-term goal is to be a leader in smart cities for transport technology solutions. Just a quick overview of our technology platforms. We have a very unique booking system that books people, parcels and goods onto the vehicles that they travel in and on. And that is integrated into, through APIs, into a lot of other data platforms. For instance, we're integrated into NDIS, My Aged Care, into payment platforms, into digital ID platforms. So before anybody can book onto a vehicle, they need to meet all of our criteria and make sure that they can be booked, or that person, parcel or good can be booked onto that asset. The other side of that is our Orcoda transport management system that manages our vehicles, buses, cars, trucks, trains, drones, etc. And that does all the scheduling, routing and optimization of every part of that process. Those two are integrally linked into an integrated transport management system. Hanging off the bottom of that is all of our different apps. We have applications in multiple verticals. So we're in carpooling, car rental, community transport, waste management, metro deliveries, and remote workforce. So all of those are apps that all of our customers use, their clients use, or anybody wanting to book anything onto any of those vehicles use our apps to track the vehicles, to see where they are and do all those sorts of things. The top end is we are linked into all of the smart devices that are going to be the future of road, rail and air transport. Most of those devices are IoT devices. They could be cameras, smart lighting, whatever. There's lots of things coming on into the future that we are linking to. We've got two other parts of the organisation, Future Fleet, and it's responsible for the installation of all the smart devices within the vehicles themselves. That's bus, car, truck, trains, etc., and connecting all of those devices back into our software solution. Because without being able to put those devices into the vehicles, you haven't got a total see-through. And then on the other side, we've got a Better, a company that is responsible for providing and installing all of the smart infrastructure. And we provide solutions for smart lighting, smart cameras for local government authorities and Horizon. We do networking and all the infrastructure for communications. So all of those then link back into our integrated system. And our vision is to be the leading smart cities transport technology provider into the future. So we've got the now, which is all of our current apps that are all income producing, and the future is linking a total ecosystem where everything is integrated. So that's a bit about our technology platform. Last year, FY23, we had 21 million of total income, which with a substantial increase in our SaaS recurring revenue stream. We had 2 million underlying EBITDA. We had a 2.5 times increase in our share price, 280 plus customers, 7,000 vehicles using our technology, and in excess of 3 million movements using all of our platforms. So all in all, last year was a very high growth year for us, and this year is going very, very well to date. If you have a look at our customer receipts for the quarter, just gone, 6.5 million, which is a 45% increase on the same quarter in the previous period. Our operating cash flows up 114% on the same quarter, FY23, 5.5 million in total income, which is a 39% increase over the previous quarter. Our customer receipts, 15.9 million, up 41% on the same half last year. So these are half-yearly results now, combining the two quarters. Our operating cash flows, 1.9 million, up 345% on the same period in the previous year. And our total income, 14.5 mil, up 49% on the same period last year. So you can see we've got major growth occurring. It's been a great journey to date, growth-wise, and the future looks really, really promising. you can see there that our customer receipts have continually grown. We have a bump in the first quarter each year, and that's mainly to do with our Mount Buller recurring revenue stream. We've got a 9-year contract there, and that delivers a quarterly result because the snow season sort of starts in June and goes through to September, October. So last year wasn't a brilliant year, but you can see there that we still had very, very good customer receipts as a result of all of the other divisions increasing dramatically as well. The company has had a 4 times increase in 12-month rolling operating cash flows. So we've been cash flow positive every quarter except 1 quarter in the last 3 years. So our operating cash flows are growing at a rate of knots. The strong quarter contributed to a record half-yearly result in customer receipts, and total income and operating cash flows increased significantly compared with previous periods. The robust growth is attributable to positive momentum in our transport management software business and a good contribution from Future Fleet. This was achieved notwithstanding adverse weather conditions and the bad snow season. So, like I said, we still had a very, very good season. The organic growth, taking out Future Fleet, which came on effectively on the 1st of July 23 and added to both our revenues and our growth. But our organic growth was 30% internally, which is great. Our transport management software business implemented several large SaaS contracts, one with Northline, which was Northline is one of the largest parcel delivery companies in Australia besides Star Trek, and the implementation of that software is now rolled out right across Australia. And in December, with the software, they complimented us because they had a 40% increase in throughput without any further vehicles or drivers being put on. So that was great to hear that. Also, Comlink Australia, a very large not-for-profit in the community transport sector. So that is all being implemented at the moment and will add significantly to our recurring revenue streams. And also, we've just signed up Refueling Solutions, one of the largest refueling companies in Australia, with their mini tankers, and they will expand onto their whole fleet once we roll out the mini tankers. Again, that will add substantially to our revenues going forward. We've also launched 2 new software products. Our vehicle carpooling is one of them. We've Teletrack Navman and Telstra, our 2 major partners marketing our product for us. Teletrack Navman have just taken it into New Zealand and done a large campaign in New Zealand. We've now had 1 local government authority there signed up and implemented, and 4 more coming on board at the moment in the last couple of weeks. And that's all happened just within the month of Teletrack launching their campaign. They think that there's 20 to 30,000 potential vehicles there that may take up our software over the next 12 to 18 months. So we're looking forward to that. And Telstra have launched in Australia with all the local government authorities. They have now got the first, we tendered with them on the first one, and that looks like coming on board at the moment. They have got the Telstra are the incumbent in most of the local government authorities right across Australia. So we're looking for a fairly big future there for our vehicle pooling solution. The very good part about that vehicle pooling solution is we've got keyless entry, keyless start, and mobilisation of the vehicle, so it's in demobilisation mode at all times, so that to substantially reduce stealing. And then we've got our vehicle rental product, which is very similar, except it's got payment platforms and a whole lot of other things for customers to sign contracts and pay online, but the same keyless entry, keyless start, and the mobilisation or demobilisation feature. The good part about that is for both of those sectors, you don't need keys, which is a big problem. Tracking the vehicles has been a big problem in the past. And obviously, with large government authorities have got cars where they share the cars amongst, or vehicles amongst all their staff. They don't need a payment platform because they don't pay. But in the rental business, we see a major marketplace there to change that marketplace to the way it operates now, because it's very inefficient the way the rental market operates at the moment. And most of you have probably rented a car and see how inefficient it is at the moment. So our software, I think, is going to make that marketplace very, very efficient. We just signed an MOU with Sharing. Sharing is a tech company that's got blockchain digital identities. We see customer ID verification as a very, very large part of both the vehicle pooling, vehicle rental, and for our local government authorities and our Mount Buller contract, it's integral that anybody that is booking a seat or going to drive a vehicle or any of those things, we want to know that that person is the person that's booking it, and that they've got all of the licenses and everything to physically drive that vehicle, because a lot of false information is given over and people steal cars with false information for a lot of our customers. So that platform is going to change the way we ID people. We're already linked into a few other ID platforms, and as we expand across other markets, we will both complement Sharing with a lot of our customers and our users, and also make available other ID platforms. We've got a very robust balance sheet, 5.3 million in cash at the moment, and 6.3 million available in working capital, with $1 million facility unused. So all up, looking very good from a balance sheet perspective. If you have a look at our smart integrated technology solutions, we've got our transport and communication infrastructure services that, like I said, installs all of the smart devices and connects them back into our software. For instance, smart lighting, train coming into a station. You don't want those lights on all the time. Integrated, as the train approaches, the lights come on, and our software manages all of that process. The same with communications and networking opportunities. Without any of that, you can't have an integrated solution. We've got our transport management solution, like I said, that manages all of the vehicles, whatever they be, truck, train, car, drone, we don't care. And then we've got our fleet management and tracking software. That's all of the devices that go into the vehicles, where we can physically see the vehicle, track the vehicle, manage all of their servicing, driver behaviour, all of those sorts of things with all of those devices. And we're connected into multiple devices for tracking. We're in with telematics, with Teletrack Navman, with GPSI, with E-Roads, and it doesn't matter what the telematics. So we integrate with all of those telematics so that people have got choice. If they want to use another vendor, we'll install that vendor technology in and integrate it with our software. And then we've got our workforce transport management solution. What that does is books people, parcels and goods onto aeroplanes, buses, cars, trucks, trains, any way that they're getting to work to remote sites. So those remote sites are mostly operated by mining companies, oil and gas, and the like. So one of our contracts there at the moment is Kestrel Coal, and we're rolling out a couple of others in the near future with 2 tenders that we've got out at the moment. So we've got very, very good technology. We've got very good profitable growth occurring. We've got a very, very experienced management team and a board with a proven track record. We're cash flow positive. We've got a good, strong balance sheet, and going forward, we're a company that's growing and growing exponentially. We just made the AFR 100 top growth companies in Australia. I think we got 54th in the Australian Financial Review that they did late last year. Our current market cap is around the 45 mil. Our shares have been trading in the range of 26 to 30 cents, and we see that rising in the future. And like I said, we've got a very, very strong and experienced team of people in-house and a strong board. So I think I've done my 20 minutes. I'd open for question time.
Cheers, thanks, Geoff. We've got a couple of questions in from the audience, so let's tackle those first. Just on the 5 mil on the balance sheet, somebody saying you've mentioned in maybe other presentations and ASX releases that dividends could be possibly on the horizon, just given the kind of where the business is and the growth coming through in the working capital facilities you have. So maybe I just touch on that capital allocation and possibly dividends coming to shareholders in the near future. Yes, look, obviously I've got to be a bit careful what I say here because we haven't made any announcements, but the goal is to be able to give dividends back to shareholders as soon as we have plenty of cash to be able to distribute. Obviously, the big thing is making a net profit. We had a small net profit last year. Should be a bit better this year. It's up to the board to make the decision on whether we pay a dividend from this financial year, and that decision will be made as we come into the end of the financial year and have our full audit done. But the future's looking good. I'm confident that we will be in a position to start directing some funds back to shareholders. We've also got a couple of things on the go that may bring a fair bit of cash in that if they come to fruition, that will bring that to the fore at a hopefully a greater rate. So looking forward to the future. And then a second question was within ODA, which is currently growing faster, the software fast track, I think it was called, or the Better Group on the other side, on the two sides of the business, which one is kind of the really all guns blazing? Yeah, so look, we got growth occurring everywhere. Our recurring revenue is growing substantially each month. And so is our contracting revenue. So the split at the moment between the two is probably 1/3, 2/3, 1/3 recurring, 2/3 contracting. My aim is to get that recurring revenue up to the same as what our contracting is. And in our contract, we call contracting revenue, like the installation of all those devices is contracting revenue. The installation of infrastructure
communications, networking, and all of the smart devices that are required in roads, rail and air. We call that contracting as well, even though it's infrastructure based. You've got to have it, otherwise we're not looking into the future. And we also call contracting where when we go and put our client, our software into a client, they also want us to do the integration into their enterprise solutions, and that becomes contracting because it's one-off. So the aim is, like I said, to get that recurring revenue up at least equal to our contracting revenue as soon as we can.
Yeah. And in terms, I mean, you touched on it in the slides. I mean, you had a big year of growth last year. You're still seeing, lots of growth this year. And, normally with businesses we've had on here before, that enterprise sales cycle, tends to be a very long cycle, but, with kind of big chunky contracts when they do realize, what's driving the take up of Orcoda's product services from your end? Is it, people can't get staff and they're looking for technology solutions to, make them more efficient? Is it the cost of staff? They're trying to, again, on the efficiency. Is it a combo of those factors?
Look, I think the main thing is that since the pandemic, the digital transformation is now an acceptable thing. Prior to the pandemic, we really struggled to get customers to make the decision to digitally transform. It's a big decision to make, to go from spreadsheets and systems that they've used in the past to going totally digital. But since the pandemic, I'd say 90% of our customers that we talk to now are ready and want to digitally transform. And I think that's going right across the marketplace at the moment. So it's making our job a lot easier as we go into these customers. And customers, they all know that they have to digitally transform to be in front of the marketplace, to stay ahead of their competitors, and to be basically into the 22nd century, because if they don't, they'll get left behind. And efficiency is what it's all about: optimization and efficiency. And that's where we are. We are out there winning contracts against all of our competitors at the moment. Like the last 3 tenders that we've won, we've been up against a lot of other competition, and we've won all of them because our product's solid. We've got a strong balance sheet. We have got the whole thing where we can deliver those efficiency and optimization solutions to our clients.
And in terms of those contract lengths for, new customers that are coming on board, do they mirror, similar enterprise contracts where it's, a 3 to 5 year kind of commitment, once they're onboarded and up and running? Or how do you contract with these customers?
Yeah, look, we try to lock in long-term contracts. Our longest contract is 9 years with recurring revenue. The average is about 3 years. So, but once our customers come on board, they're very sticky. I don't think we've lost the customer that I can remember. So it's they're all sticky, and we're I presume in a fairly strong place with our customers in that they respect what we've got. They know we're solid. Another big thing is all of our developers are Australian based, which is another big thing for when our customers are making a decision. Having all of our tech team here, we're agile, we can do things quickly, doesn't have to go off to the US or UK, where most of our competitors have their software developers, or off to Asia, where decisions take ages. There's no agility, and we have all that here in Australia, which is very good for our customers and a lot easier for us to deliver.
And in terms of international opportunities, Geoff, expanding out of Australia from the presentation, I gather you're not operating outside of Australia, but is that something on the horizon if we look forward, 12, 20 more months, 24 months from now?
Well, we've just launched into New Zealand, where we haven't been before. We've done that with Teletrack Navman this month, so that's a major move for us. Teletrack want to take us into the US and UK. We're not ready yet for that, but that's on the horizon. As we don't want to grow too fast and all of a sudden not be able to support things. So we want to continue our high growth, but in a very, very managed fashion.
Okay, perfect. Geoff, I think we'll leave it there. Thanks very much for coming on and joining us this morning. It was great to hear the story firsthand.
Thank you, Mark, and thank you, everybody.
Geoff, if I could ask you to just please stop sharing your presentation. And I do know we have Brendan Malone. There he is, standing by from Raiz. Brendan, if you want to start sharing your preso, I'll let you know when it's up on the screen.
Yes, morning, Mark. Got a new laptop last week, so just let me fix these settings.
Yeah.
Not reading it for some reason. Sorry, guys, it worked in the test, but it's not picking up my screens at the moment.
I'm just double checking something on my end, Brendan, just to make sure it's not. No, you should definitely be able to share it.
It's asking me to log out and log back in again, Mark. Just give me 10 seconds.
Okay, we can do that.
Hey Mark, how you doing?
Hi, Katie. You don't happen to have the presentation that Brendan has there now?
Way to have it somewhere.
I'm presuming it's the one that went with the 4C, unless there's been a slightly updated
no,
one
we
for any
released
reason.
one yesterday.
Yeah.
Just triple check.
Okay, Brendan is coming back in here. Let's just see. I'll ask him to unmute quickly. Sorry, just bear with us, folks.
This one.
Yeah, it's coming through now, Brendan. Yep, there we go.
All right, morning, Mark. Morning, all. Sorry about that slight delay, so I'll crack straight into it. My name's Brendan Malone, CEO of Raiz Invest Limited, a leading wealth app available here in Australia. We have operations in Southeast Asia, which I'll talk about. But the aim and the underlying proviso of Raiz is to grow your wealth. We break down the barriers to investing and savings to all Australians or all customers, along with hands-on experience and financial education. Today, I'll run through Raiz at a glance. Then we'll have a quick run through of what products we offer to our customers. We'll have a run through of the Q2 FY24 highlights. I'll touch on the revenue model, the marketing strategy. We'll have a look at the opportunities in the addressable market and why we are in this market. A little bit on our customer competitor landscape, I'll finish up with some strategy slides and direction and focus on where we're heading, and then wrap it up with some investment highlights. So moving into it, Raiz at a glance. Raiz, at the end of the day, allows customers to invest from as little as $5. And what does that actually mean? If you downloaded the Raiz app from the Google Play Store or the Apple Store right now, within the next 4 or 5 minutes, you will have opened up an account, and you can direct $5, a minimum of $5, to a portfolio of your choice. We offer 9 different types of portfolios. We have 5 which are conservative to aggressive. They include 7 ETFs that are quoted on the ASX, just blended between a conservative model and an aggressive model. We have an Emerald portfolio, which is our socially responsible investment themed portfolio that has 4 ETFs in it that are quoted on the ASX. We also were one of the first organisations in the world to offer a Sapphire portfolio, which has a 5% allocation to hardcore Bitcoin, so that anybody that was interested in that space can have a look in a controlled environment. We also have a property portfolio, which currently has 11 residential properties here across the Australian market. And we also have what we call a Raiz Plus portfolio, which I'll touch on later, which was launched on the 1st of August last year, which then actually breaks down the opportunity. So for as little as $5, you can go into 49 ASX listed stocks, 30 ETFs quoted on the ASX, an allocation of up to 5% Bitcoin, plus our residential property up to an allocation of 30%. So the portfolios are broadening as our customer base is broadening, and we'll talk about the opportunities of our product development later. We came to the Australian market in February 16, so we have our 8th birthday next week on the 10th of February, and we listed on the ASX in June 2018. When we launched in the Australian business in Australia in 2016, we were known as Acorns Grow, which was a 50-50 joint venture with Acorns Grow Inc. out of Newport Beach in the US. Over the last sort of 14, 15 months, we've turned the focus back onto the core Australian operations. And then quite happily yesterday, we had record active customers and FUM as at the 30th of January 2024, which was 299,000, or just under 300,000 active customers, and over 1.24 billion in funds under management. So what is our product? As I said, if you downloaded it from the App Store or the Google Play Store, it's an app that sits in the palm of your hand or on your mobile phone. We offer a range of different opportunities in there. So the original one is Raiz Invest. And when I say that you can invest for as little as $5, there are 4 ways that you can get your money into this Raiz Invest product. The first is through what we call roundups. So you link your debit card or your credit card to the app, and we see those transactional costs come through, and it might be Caltex or Rebel Sport, and whatever those amounts are, or you buy a coffee downstairs at the coffee shop, we see that transaction as $3.50. We would round that to $4. So we accumulate those little roundups, and once those roundups either get to $5 or $10 or $15, wherever you set your threshold at, we will direct debit your bank account and then turn it into your portfolio the next day. That's the first way to get funds into your Raiz Invest account. The second, and probably one of the most popular, is this reoccurring. So it's automated savings, where you can sit and say, I want $1 a day, $1 a week, $1 a month. We see a lot of customers either get paid mid-month or at the end of the month, so the 17th or the 2nd of the month, we see some recurring deposits come in. You can also do a lump sum deposit. So as an example, we see some one-off lump sum deposits come through July and August when customers receive, fingers crossed, receive a tax refund, and they will put it into their savings account. The fourth way, and the fourth screen across the phone screen on the slide, is what we call Raiz Rewards. So we have over 1,300 retail merchants in the app, and if you click on those links, so it's online. If you click on the screen an Apple or an eBay or an LG or Event Cinemas, you go through and you do your normal course of spending and buy what you need. But that merchant then will put cash back into your Raiz account. So that also contributes about anywhere from 4 to 5% of our fund inflow coming into the funds. And what I like about that is that it's keeping it in the ecosystem. As I mentioned earlier, we have a Raiz Plus. We've put this screen out separately because it is in Raiz Invest, but it's an opportunity where we can have direct access, or customers can have direct access to 49. It was 50, but Newcrest has come out of the 50. We have 49 ASX listed stocks that you can sort of fractionalize or get direct access to. So that's quite an innovative feature. We also have what we call Raiz Invest Super. It's a superannuation product. So my superannuation is paid by Raiz Invest. It goes into my Raiz Super account. So we see that as a key area to grow. We only have a limited number of our circa 300,000 people using our Raiz Invest Super product, but it's definitely on the strategy and the go forward for our business growth and opportunity. The superannuation business has been consolidated over the last 12 months. We did an acquisition of a business called Super Estate, which was the property fund, 2.5 years ago now. We merged those two together last year in July. So now we offer one single superannuation offering that includes all those portfolios except for the Plus product. The Plus product went live on the 1st of August last year, and we're just talking to our trustee at the moment to get that Plus offering into the Super, so we can give our members a bit more control over their investment portfolios inside their Super account. Raiz Rewards we spoke about. It's a great opportunity to sort of squirrel away some extra savings, especially when people are going to spend money anyway. I think one of the biggest philosophies that I like about the Raiz product is we don't want to tell people what to do, but everybody knows they should save. So if you're using a program like Raiz Rewards, you're going to spend that money anyway. Why not get some cash back into your account? People ask me, well, what's in it for the merchant? What it is important from a merchant or a retailer is that they've got advertising in the app because people will see their logo. They don't pay any marketing fee away unless there's a guaranteed sale, which is in this case is the cash back to the investor's account. We also have a product called Raiz Kids that's been operating about 14 or 15 months now. It's a simple and easy way for either grandparents or parents or dependents to have to grow or start planning for some sort of investment for their little ones. I've got a 5-year-old son and a 3-year-old daughter. I put $50 a fortnight into each one of those accounts. And if the market does what the market should do over the 18 years or the next 13 and 15 years, there should be a nice little nest egg there for both Thomas and Isabel. That's the core product offerings that we offer today. Now, just touching back on where we are on the Q2 FY24 highlights. As I said, for the last 14, 15 months, we've really refocused our strategy back onto the Australian business. And the reason I say that is we moved to the Indonesian and the Malaysian and the Southeast Asia opportunity a couple of years ago. And what we've realised is that there is still a lot of growth and opportunity here in the Australian business, which is a lot more lucrative and provides us with the revenue that we have. So we've readjusted those joint ventures up there. We made an announcement on the 21st of December that we're closing the Indonesian operations, and that'll take a few months to sort out. We're working with our great partner up in Malaysia, PMB, to sort of restructure the day-to-day operations up there to make sure that they have control of what the Malaysian customers want. And there'll be more to come on that over the coming months. We have a license application set to go in Thailand, which is on hold at the moment. But whilst the reason we've come back to the Australian business and the numbers are starting to show it that are coming through now in the Q2 FY24 results, and particularly the operating cash, you can see over the last 2 quarters, the September 23 and the December, we've turned the business around into an operating cash flow positive business. The majority of that revenue and the cash comes from the Australian business, and hence the focus back on the Australian business. The Australian revenue over the last quarter was up 6.7% to 5.24 million, with an average run rate per user up 21% to $69 per year in the first half compared to the FY23 full year. We do have minimal churn. I think there's a strong case, if you look back over the history of the organisation and our customer numbers, is we've done 3 different fee increases over the period of time. And the last one was a sort of a 25% increase in the fees on the 1st of August, and we saw minimal churn, and our active customer numbers have stayed very positive. And how do we do that? The biggest thing is product innovation. We've increased FUM across the line over the last couple of months, over the last 14, 15 months with our property funds, consolidating our superannuation businesses and also the kids product. And we now have a record FUM of over 1.24 billion on the platform. 3 years ago, just under 3 years ago, Seven West Media, Seven West Ventures, took a placement of $10 million and provided us with $8 million worth of contra advertising and $2 million worth of cash. We launched a new campaign, which I'm very excited about. And I think these numbers today, and particularly over the last 30 days, shows that we've launched a campaign. We're getting brand awareness out there, and we had what I call a good summer of cricket brand awareness. And those results are coming through, and with the increase in customer numbers, we've added 6,500 new active customers in the last 30 days. And with that new customer acquisition and the movement that we've had with our operating cash flow, moving to 856 positive for the quarter, 198% improvement quarter on quarter, shows that we're on the path to a positive EBITDA. Focusing on the core Australian business, there's just some visuals on why and what we can do with the Australian business, with our active customers just shy of 300,000, 1.2 billion in FUM, and an average run rate per user of $69. Now the question, a lot of people ask, well, what is our revenue model, and where's it all coming from? I think what I like about the business and the structure that we have, that there is multiple revenue streams. As you can see here, we've got 63% of the revenue comes from our maintenance fee. Now that's the monthly fee we charge customers under, if their account balance is under $20,000 or $25,000, depending on what portfolio you choose. And what we do with that, either $4.50 or $5.50 a month, we direct debit that out of their bank account, not out of their account balances. On the account balances, if you are, or the account fee, which contributes 61% of our FY23, 21% of our FY23 revenue, is the account fee, where we charge 27.5 basis points annually, taken monthly out of your account balance. We also have some advertising revenue, which is this Raiz rewards program that I spoke about, where the merchant pays us and then we pass on that cash back into their accounts. And a lot of merchants are also paying to actually advertise either through our EDMs or actually in the in-app itself. I think there's still a lot of opportunity on the advertising revenue to go. And we also have a netting revenue, which is the bid offer spread captured, where the acquisition or disposal of an ETA unit does not require an on-market transaction. And what does that actually mean? I think the underlying technology of Raiz, it really gives us the competitive advantage, where it does everything. The technology stack does everything from customer acquisition, downloading it, acquiring them, signing them up, right the way through to the funds management. If you do invest $5, at the end of the day, you'll have a trade statement like you do on any other trading platform. We provide a month-end statement that will say, this was your opening balance, this is your deposits, this is your withdrawals, this is any distributions received, this is your closing balance. And then it's all detailed transaction by transaction. And at the end of the year, we provide it's a fully automated tax statement that tells you where and what number you need to put into your tax return. So the underlying technology stack's very strong. Just to touch on our product innovation, and I think I mentioned that the way that we keep and retain our customers is through continued product innovation, and that's why it's core to the strategy moving forward, that our focus is back on the Australian business. And an example of it is this product launch that we did in August, which was our Plus, where I was talking about. We provides customers with the ability to add selected ASX stocks into their portfolios. The previous slide was about the revenue. I've just stuck up the pricing structures here on the right to say that our standard portfolios are $450. Our Sapphire portfolio, which is the Bitcoin portfolio, or a 5% allocation of Bitcoin, is $450 plus the maintenance fee. And then we have our Plus model and our property portfolios and the revenues. Obviously, there's two key parts to our business. One's the technology, but the second one is also the growth and the customer acquisition, and hence the partnership with Seven West Media 2.5 years ago. So we've kicked off this campaign, which is Your Raise Your Game campaign, that started on the Boxing Day test, and we're quite excited with the results shown so far. We will soon kick off the Raise Your Game campaign through the AFL and the AFLW that kicks off on the 8th of March. and runs right through to grand final day. So we are looking forward to the results that we've seen in the last 30 days over the next 7 months, starting from March through the AFL season, which is quite positive and exciting. One thing to note on that is that it is the contra spend, and as at 30 June last year, we had a $4 million credit, and those credits will be used up through this calendar year till December this year. So there's a massive opportunity here in getting that brand awareness and creating that top of funnel. Trent Copeland in the middle there was our spokesperson pretty much through the cricket, and our ambassador, and Abby Holmes is going to be leading the AFL and AFLW campaign through the next 7 months. Now, people say, well, why do you do this? Why are you in the Australian market? And I think it's there is still a massive opportunity. You can see in the purple that we have a 300,000 active customer base, but the opportunity is quite a lot. A recent survey, or a survey sort of this time last year, or I think it was April last year, from the ASX, drew out that there's about 1.3 million new investors or non-investors intending to invest in the next 12 months. And I think the way that we've positioned and refocused the Australian business, brought the superannuation funds together, created the Plus product, Raiz is sitting at the forefront there to acquire these new customers and give them a step into the investing world. And another tailwind that we all know in the Australian market is the superannuation market. And with the work and the back end work and the administration we've done over the last 12 months, we're very confident to be sitting there to acquire new superannuation customers. And I think the important part is that we've got 10,000 of our users using Raiz Invest Super, and we've acquired those customers by advertising in-app. We've never actually spent any money. It is known in the industry that the cost of acquisition of a superannuation customer can get quite expensive. So we've done it by ourselves. What we have done in the last sort of 2.5 months is partner with Employment Hero so that we're on a new channel looking for new customers. And I'm quite excited over the next week to see how that rolls out, with the super guarantee being paid in the last couple of days from employers. So there's a massive opportunity there in our addressable market. Just to give everybody an idea of where our customers and the distribution of our customer and their balances are, I quite like this graph where it shows that we have the kids' accounts and the zeros and the 1-year-olds and the 1 or 2 month olds, and we go right the way through. And at the end of the day, I think the lifetime value of a customer and the trust and the relationship that we've built up to date over the last 8 years will continue. It's a model, especially in the financial services industry, that has worked in the past. If you build that relation, you build that trust, you deliver strong customer support, our customers will stick to us. So we can see a massive pipeline, and our plan is to deliver products that will suit these customers in the financial services journey of their life at the right time. Sorry, Mark, I'm just conscious of time. There's a quick slide on our competitors. There are a few competitors out there. I think I mentioned that our technology stack gives us a massive head start on it. It's current, it's modern, there's no legacy systems. We have our own AFSL license, so we can move pretty quickly and for the benefit of the customers. There's a quick graph on the history, which I've explained at the front. That's more for reference and showing that we have had that growth across the Australian customer numbers over the last 8 years. Our strategy, there's 5 points there. I think the core of it is that we deliver great customer service and UX, but we continue listening to our customers. The social responsible portfolio of Emerald, the Sapphire with the Bitcoin, the Plus and the property, they all have been requested and asked for by our customers, and we keep delivering and listening to them. Executing on our strategy, there's 5 quick pillars there. Again, customers, maintaining brand and reputation, exceptional product and services with the operating leverage that we have. The key now is that we've got 300,000 customers. We've got them in Raiz Invest. Now we want to cross-sell them into our other revenue-generating products. And as I mentioned, there's a huge opportunity there in not only our super, but also our Raiz Rewards opportunity. And then over the last 14, 15 months, we've really worked hard on our cost of capital and deploying that capital in the right areas, as well as I believe now we've got the team that we need to continue to deliver this next level of growth. There's 6 quick highlights of why to invest or why to consider Raiz. It is the leading platform out there at the moment, and we are very scalable. The technology was it was the Acorns technology, and we've changed that a lot over the last 8 years. However, the Acorns business in the US has $4 billion of funds under management and 4 million users. So we've got in our testing environment, we've got a lot of different investments in there, and we're testing it so we know that it's scalable. We've got a proven track record over the last 5 years that we are here to stay. We've got longevity in our business, and I'm looking forward to moving forward, which means we are focusing on the lifetime value of our customers. We continue to provide exceptional customer support, and that is key to building that trust, loyalty, and relationship with our customers. Innovation will continue bringing new customers, but also re-engaging our either low active or inactive customers back into the app. And we provide best-in-class technology. As I said, it's modern, we can adapt easily, and we spend a lot of time and focus on cybersecurity, making it safe. And then at the end, it is the operating cash flows moving in the right direction, with more to come, and we're on path to a positive EBITDA. There's a bit of the corporate structure and the capital structure, but I think in the interest of time, Mark, I'll hand it back to you for any questions.
Thanks, Brendan. Just one historically, well, not one for me to start off with. Let's just say that. Historically, it has, and I mean, the banks are a kind of a clear example of this. It can be difficult for whatever reason, for consumers to take multiple financial products from the one provider. So, that the strategy you're talking about of getting them into more products, whether that's, Super or the kids one or, any of the other offerings. Can you just give us a sense, a base case of, now, like, on your average Raiz consumer, are they taking 2 products and you're trying to get them to 4, or just kind of give us your idea? And then the second part of that is, like, I guess, what are you guys going to do differently to kind of get this cross-sell thing? Because, for somebody to say, okay, I'm a Raiz customer and I'm going to flip now and, do as Brendan does and get my Super into Raiz Super. So maybe just talk about that a little bit more if you could.
Absolutely. I think the important opportunity here on the cross-sell is that we've had customers in it, and it's I don't like to say it, but it is a set and forget product. People set up their recurring setup and then they go away. They come back 6 months later, they come back, or they've set a savings goal. I need to travel. I'm going to Bali in November. I want to save 2,000. It's getting them to use the app and making them aware that we've added all these additional products and opportunities. I was at the beach the other day and I was talking to a mate that's been, or a new friend that has been using it for 12 months, didn't know we had Raiz Super. So it's getting the awareness across, and we've spent a lot of time over the last couple of years and focusing on new customer acquisition. We've got a new head of marketing that joined in October, and it's the first time we've had an experienced head of marketing who's already working on, and I think the numbers are showing it, that on the re-engagement. It's, you opened the app 4 years ago. Do you know we've had this, and this, and this added to it? And they go, oh, cool, didn't know that. Or the customers came in, we did what we needed to do. We financially educated them, gave them hands-on experience, and they may have gone off to a ComSec or somebody to do direct trading. Well, did you know we have Plus now? So they're coming back. So there's the product innovations there. We've cleaned it up. It's now there's 2 opportunities for growth for us at the moment. The first one is that 7 West brand awareness and bringing new customers in it, which also ticks the re-engagement, because you might have watched the cricket and gone, oh, Raiz, I had an account, I'll go and check it out. But there is also a massive opportunity. And if you look at the customer funnel that we have, there'd be about 1.2 million people have signed up to the app. We have about 700,000 that have been KYC'd, but only 300,000 active. So there alone is a massive population, or massive opportunity to re-engage, and that is what we're kicking off now. And even some of the work we're doing with 7 West and 7 Red IQ is to identify those customers who have had Raiz but aren't using it anymore, and get the right positioning on the advertising in front of them.
Yeah, 2 questions from the audience here, Brendan. So let's try and squeeze these in. Life insurance question, has that in market research or feedback from clients, is that kind of something that people are looking for from Raiz at this point?
Look, we get requests for a lot of things, and definitely life insurance. I think what the overarching comment to that would be, we've got this relationship with our customers in our product. Then we've put Raiz Rewards in front of them, which is all the retail merchants. As that relationship grows, we want to look at putting financial services products. And as I said, we've got zeros to 60s and 80-year-olds. What financial services products do they need at what point in their life cycle or their life journey? You know, when's life insurance important? When is there a personal loan, or Mark decides to get his Lycra and buy a carbon fiber bike and join that? Does he need a personal loan for that? So it's putting the right product in front of the right customer. And so what I enjoy about, especially being in the financial services, the positiveness that our customers are asking for. They're not shy to tell us what we want. An example, we added 7 new ETFs into the portfolios last week because our customers were asking for the AI, the robotics, dividend yielding sort of ETF. So we listen to them when we deliver, and then they are taking the product. So life insurance, income protection, a lot of them. We do have a white labeled insurance in there in the Raiz Rewards program at the moment, and we'll continue to build that out.
Then a question on the kids accounts. What percentage of new accounts are kids accounts? Well, I guess, maybe phrase it slightly differently, parents, grandparents, who are the kind of primary user, how many of those are kind of, adding that functionality of putting the kids or grandkids accounts in there? Because I think you have mentioned that before. It's quite popular with that, the really older demographic, if I can say that, to have a grandkids account in there.
Absolutely. The feedback and what we hear through our support channels is it's not the bank of mum and dad anymore. It's the bank of mum and dad and grandparents. And this is where Raiz Kids is really pleasantly surprising us. I think the last number that we reported was about 33,000 Raiz Kids accounts and $23 million of FUM in there. So it's about 10% of our active customers have Raiz Kids accounts attached.
Okay, perfect. Brendan, we're just up on time, so I'll leave it there. I just want to be respectful of your time and everybody else. But listen, it was great to have you back on and hear the story. And for anybody who hasn't heard, Brendan is going to be presenting at our in-person conference in Sydney on March the 14th. So if you're keen to hear more from Raiz, please check out the tickets on Humanitics for our upcoming in-person conference.
Brilliant. Looking forward to it, Mark. And if there's any questions, please don't hesitate to shoot through an email.
Exactly. And we'll leave it there. Thanks, everybody, for joining the call this morning. And I wish everybody a good weekend. Thanks, Brendan. Thanks, Katie.
Thanks, Mark. Thanks all.